Hello Sector Watchers, welcome to the 35th episode of Sector Spotlight on Tuesday the 16th of June, recorded on the 15th. I'm Julius the Kempenaer and I'm presenting from Amsterdam, the Netherlands. I love to hear from you, so if you watch the show on YouTube, please don't forget to like the video, or even better, share your thoughts, ideas, suggestions, etc. in the comment section below. I do read them and I respond when it's useful. Of course, you can always send an email or use any of the social media handles to stay in touch. It's a full show today, so we need to get going right away. So, last week, once again, stock markets made headlines. If it's not for a rally that continues far beyond what everybody was thinking, it is for a sharp drop that all of a sudden everybody was expecting, of course, as we always do. Let's see what happened. Let's start with looking at what happened from an asset class perspective last week. And I've loaded up the RRG with some asset class ETFs here on the left. And as you can see, it's showing you 5 trading days until June 12th. That was a Friday. And not surprisingly, US government bonds are leading the table with a 1.1% gain. And at the bottom we find the stock market, ITOT, with minus 5.1, followed by VNQ, the real estate ETF, at minus 4.8, and our benchmark is coming in at minus 2.7. It's wild. It's been wild for sure, and we have to look at these tables and see what happened over last weeks, and these numbers are not super nice, so to say. We'll dive into this a little bit later in the show, because when this type of thing happens, I always like to step away from the daily noise, what's happening during the day, because with these wild swings, there's a ton of opinions flying around left and right, and it's like a battlefield where, you know, there's a lot of fighting going on, and then, you know, when everything cools down and all the dust is pulling up and the smoke is gone, you can actually see what has really happened and assess the damage. And we're going to do that later on if we're going to take a look at a little bit longer term time frame, because I think that this 1 week is what it is. It's just 1 week. It's not necessarily a really representative for what's going on in the markets over the last few months. So if we quickly go to the sector RRG to do the same thing for the US sectors, we see a similar big moves happening. If we sort the table here, we see that technology, which is really becoming the new defensive sector. I mean, in a week where the market lost almost 5%. Technology loses only 2%. That is a very strong relative week for technology. And similar for communication services, which lost only 2.5%. And then we have what you would expect traditionally defensive sector like staples with almost minus 4. Now we've got real estate and utilities minus 4. And then the real bad stuff comes in with the sectors that had been gaining a lot recently, and these are energy, financials, materials, around 10%, 9 for financials, 11, over 11 for energy. I want to quickly have a look at the image for the S&P 500 before we dive into longer term asset class and sector rotation stuff, working our way through the investment pyramid. I've loaded up a daily bar chart for the S&P 500. I don't usually look at that very often in the show, but I thought it was a good idea to do that now, because I see a lot of respect for levels, so to say. First of all, standing out here is a very well-known technical sign. It's a clear-cut island reversal where you gap up, stay there for a couple of days, and then gap down, and you got this gap on both sides, creating that island. That is a trend ending characteristic. So if you look at that, it would be a negative for the S&P 500, at least for the short term, because this uptrend likely has ended. but we're not there yet. What I like to see to confirm that is a new high that is lower than the 32.33 that we've seen on Monday. Actually, this was the Monday, Tuesday, Wednesday, and then this is the big drop down is on Thursday. So we started pretty good on the week. We leveled on Tuesday and Wednesday, and on Thursday we got the big kaboom. Friday we recovered a little bit, and I'm recording this during the day on Monday the 15th, and you see that we actually opened lower, dipped a little bit, and during the day we're already rallying again. And now it's becoming really interesting, because for this island to really work and become the end of the trend, we do need to see a first lower high to be put into place, and then preferably followed by a new lower low, which would mean a low below today's low. We're not there yet. We're far from it. So we can't. I don't want to really call this the end of the trend. I think that would be very dangerous. We need a little bit more confirmation to do that. And the reason that I'm reluctant to do that is because I see still some positive signs in the sector rotation that's going on. Also, the low of today, which was let's look at it where we are now, 2965, is pretty close to the highs that we've seen here. That's 2955 and 2945. So this old resistance is now being respected as support. That is a good thing. I think if we would draw an imaginary support line here, that comes pretty close, and we are like inside this sort of emerging trend channel. The high that we've seen was also respecting a previous low as resistance. So far, this rally is actually respecting all our technical support and resistance levels pretty good. So let's keep an eye on that going forward. For the short term, the island that we see here is definitely a negative, but I'd like to see it confirmed with a high that is either, well, the lower the high comes, the weaker it is. The further the high is able to push into that gap area, the stronger it is. So we'll just have to wait and see what happens. Here is the asset class pyramid that we work our way through every now and then in the show. Let's start with the asset classes and bring up the RRG for asset classes. And now we're looking at the weekly, and we're looking at the longer term trends. And you see that my coloring of the asset classes reflects my thoughts about it. Real estate has been moving up, but it's far away to the left, which makes it still a very vulnerable asset class. We very recently ITOT from weak to neutral because of this tail that started to move higher. Despite this weak last week, this trend is unharmed. The trend of the stock market is still reversing from being underperforming to picking up. So we had that big downtrend and we're working our way higher. We were still working off that premise that it was a bear market rally, but I sort of threw the towel in 2 weeks ago and I said, okay, this is now getting much stronger than we anticipated. And so you need to, at some stage, just, admit that maybe things are changing. And I think that change is still going on. So I'm going to stick with a neutral view for ITOT. And as you can see, government bonds are on the way down. I'm going to stick with them neutral as well, because I think that the rotation stocks bonds is now at a crossroad. When I was preparing for this show, I thought I can probably come up with a narrative and a rationale for stocks to start outperforming or continue to outperform bonds, as I could come up with a narrative the other way around, arguing that stocks would have to come down and underperform bonds, so a preference for bonds. So when that happens, I know that it is like it's a coin toss. So I need to be neutral on both until the market gives me a clear direction. Now, what is very clear is high yield. That is powering further into the lagging quadrant. So I'm going to stay underweight or out of high yield right now. And I actually do like the corporate bond ETF, corporate bonds LQD. And let's have a look at some of those charts. Let's start with the stock market, because that's what everybody wants to look at. We already had a little look at the S&P on that daily chart. And here we see the same, that there is quite a lot of respect for the old highs and lows as support and resistance levels. As you can see on the weekly, there is no gap whatsoever. So if you would only look at weekly charts, you would not be aware of the fact that there is an island reversal going on, and you see that we're now bouncing off this previous high as support on the way higher, and this rhythm of higher highs and higher lows is still intact. So if you look at this chart, that uptrend that we're working our way off from the March low is still intact. And if we look at the relative strength versus the VBINX benchmark, that also is still in order. There's no problem. We see higher highs and higher lows. Little dip here because of that decline during the week, but the trend is unharmed and the RRG lines are still both pointing higher. If we switch to the government bond chart on a weekly basis, you will see that it had trouble taking out that high. We discussed that in a previous show. We rolled over, and this could very well be a first low, and it'll be pretty crucial to see if we will now be able to push through that resistance level, or whether we start to roll over again and go even lower, which means pushing yields higher. From a relative perspective, it's kind of in the middle. The RRG lines are pointing lower, and that's what's causing the tail to rotate towards the lagging quadrant while inside weakening. The good stuff is coming from corporate bonds. I do think that this pattern here is too long to be called a flag, because it's on a weekly chart, and this is about 6-7 weeks, and that is too long to be labeled as a flag if it were on a daily chart. But it certainly has some of the characteristics. It is a small consolidation. We broke out and we move higher, and we're now actually pushing against this old high as resistance, and we started off the week pretty well again. So I'm sticking with a positive view for corporate bonds, especially when it's able to take out that former high. That could get an acceleration. Now, one thing that I need to share with you is the commodity chart, because you may remember that I had the commodity section grayed out because of the liquidity issues with the iShares ETFs that I use to subdivide the commodity space into some sub-indexes. And I actually put in a call to Mr. Commodity, my good friend Greg Schnell, and I asked him what he would use as a breakdown if you would want to have a high-level overview and breakdown of the commodity markets. And he suggested going to the S&P GSCI family. So I created a new RRG for that, and that is consisting of the S&P GSCI indexes, and GNX, dollar GNX, is the overall commodity index. By the way, this is now available for you as a predefined universe in the drop-down. If you go here, you see that there is S&P GSCI commodity. If you load that, that will give you this RRG. Now, it's a slightly different one than the DJP version that we used previously, but not too much. This is a little bit more energy heavy. I need to do a little bit more studying, but from what I read and what I found out is that this particular commodity index is pretty energy heavy, and you can see that because GJX, the energy index, is pushing higher while all others are pushing lower. And there has to be some sort of a balance. So this is a very heavy weight sub-index, and it's dragging all the other ones down. We can have a look at all these individual charts, but for now I'm going to stick with the commodity space. Let me show you the chart for that commodity GNX. You see that the DJP was still working below this 2016 low. GNX is already above it, but the overall picture for commodities remains weak despite the recent rally. And if you look at the relative strength versus VBINX, that is very clearly still a downtrend. We're in some sort of a recovery, but way too low to call anything remotely like a new uptrend for commodities. So here in commodities, basically the only thing that's really interesting is the energy space. Let's move to the yield curve. That's an interesting moves going on there right now. This is showing you the weekly rotation, and these are the longer dated segments on the yield curve, and these are the shorter dated segments. This decline means that longer yields have gone up because the price has come down. So yields have gone up, and here the price has gone up, so yields have gone down. So at the shorter term end, yields have gone down. The longer term and yields have gone up, which is called a steepening of the curve. This is what's called a steepening of the curve, and that's what you see when you look at this RRG. I'm probably gonna do a little bit more work on this, because I think it is, if you really want to look at things from the negative side, then this could be something to be aware of. It's a bit of a long shot, but if we look at S&P with the yield curve, the 10-2 yield curve, so that's the difference between 10-year bonds and 2-year bonds. Now what you're looking at right here is the bar chart is the S&P 500, and I believe it was last week that I explained on using log charts, or someone asked if I did not use, well, here you see I use a log chart, and the reason is because this history is so long that if I would not use a log chart, you would not see the highs and lows as pronounced as they are right now. So here's the log chart of the S&P 500. The gray line, the thin gray line, is the 10-2 yield curve, and that is very simply $USD 10 years minus $USD 2 years, and I've smoothed that with a 12-month moving average just to give a little bit of a bigger picture. These overlays are not always like super in sync, and they're not going to give you like a pinpoint signal or something like that. But what I want to look at is it looks as if we are putting in a low here. And if we look at the previous lows, then especially this one here is sort of coinciding with the low at the end of 2007. The low here is coinciding with the high of 1999. Is that, yeah, that's no 2000. And here you are in the area around 1989, 1990. This was a pretty big drop actually. It doesn't look like that, but it was a pretty big drop. And obviously here more pronounced. We got a big decline at the early 2000s, and then we got the 2007, 2008, and we're at a very high level here. Now that leaves us with what we see here, which is sort of difficult to rhyme. Maybe that that relationship doesn't work anymore. I don't know. I'm not going to put a ton of emphasis on it, but I just wanted to point out to you that that yield curve has now started to move up. And remember, below zero we have an inverted yield curve, and there was a lot of fuss about it last year. You can see that there have been instances where we had a much more inverted yield curve here, late 90s, early 2000, 06, 07, 1989, and here it was, if I remember correctly, only a couple of hours during one day, and probably even outside of trading hours in the US, that the yield curve really got inverted. The 10-2 yield curve got inverted. But I do see a pickup of the steepening of the curve, and I am going to keep an eye on it, because as I said, right now I'm sort of in the middle. I want the market to come up with a clear signal. That's why I'm sticking with a neutral view for stocks and for bonds, but I'm trying to gather some evidence on both the positive and the negative side. And on the negative side, we have the island that's been put into place, and I could add this, steepening of the curve that seems to be starting to emerge. If we go into an international perspective, then if we put the US versus the rest of the world, then actually the US is still not doing too bad. If we look at that, the US is here. It just moved from leading into weakening, but as you can see, that tail is very, very short in comparison with the other tails that you see on this RRG. So it's a stable uptrend. It's still doing relatively well. The near term, we have seen some up moves in like Indonesia, in Russia, in India, and Mexico, picking up only a little bit. Very weak was the Hang Seng, was Hong Kong, and Australia picked up a little bit. This is Toronto, and this is Brazil, doing very well, but far to the left. I was looking for this one here, China. So China and Hong Kong are really starting to underperform the world, and definitely also the S&P 500 right now. In my pair trade overview, I have a short position in the ETF for the Hang Seng for Hong Kong. Let's quickly move to the sector space for the S&P 500, what we see there. This is the weekly RRG, where we can see a little bit longer term trends. And that's what I meant with that article that I showed you here, is an article that says yesterday's impact on sector rotation. And that's trying to make sense of these rotations here. And as you can see, there are not many weird or strange hooks. So the impact on these longer term trends is very, very limited. And if we walk our way through these tails, then we have XLB. That's the only one that now starts to roll over a little bit. And that's only with today's price action, because this is at the end of last week, and this is including today's price action. And you can see that most of these trends are just doing what they need to do. And you can actually see that technology, even, well, it's only Monday, so it's very, very early in the week, but today's price action is already pushing technology back into the leading quadrant. And I think it's a great example of how a short tail is indicating a very stable trend. Look at that tail of XLK versus the tail of XLV, or some of the other ones that you have on the graph here. Now, which sectors do we want to talk about? Let's not do all of them. Obviously, communication services is doing pretty well. It's sticking there on the right hand side. It's breaking out of that range that we discussed last week. We do need at some stage to break above this old high to continue this rally. But so far, it looks as if we have put in a new low, albeit very shortly here, around 52.5. And we're already pushing higher again. So from a relative point of view, but also on the price chart, communication services still looks pretty strong. We've been warning for energy despite that massive rally that was going on. We've been warning about that move in energy for quite some time, and you see that now that was one of the strongest declines. It has a clear-cut high in place right now. That's your new resistance level to watch. And as you can see, this massive rally, it was a massive rally, almost it doubled in price, and it wasn't able to push that relative strength versus SPY significantly higher. We didn't get further than just some sideways consolidation, and I wouldn't be surprised if this becomes a serious high and we roll over to new lows again. If we then move to financials, that is a somewhat similar chart, pushed a little bit higher than expected, but look at that relative strength. This is going nowhere. We need a lot more price action for this to become even remotely bullish, so we're still on that left-hand side of the RRG. Let's go to technology, because technology is doing very well and it continues to do very well. Look at this, is the relative strength that you want to see if you're looking for outperformers. We are at very high RS ratio levels, but it doesn't seem to hurt. The momentum is, well, sort of gone, but it is still there, and that's causing that short tail on the RRG, which means a stable trend, and that's what it is. It's a stable trend. Look at this. This is a stable trend. It's going right higher. Here also, just like communication services, we would like to see this moving beyond the former high and to keep that trend intact. I have one change that I made, and that's for the consumer staples sector. It was on the right-hand side of the RRG. It is moving. It has now hit the lagging quadrant, and on the daily RRG, it's already rolling over inside, improving. And there is just no way that I can keep this on an outperformer. It did not make it to the all-time high levels. It is respecting resistance here around 60, 50. This just looks weak. The only positive thing that I can see here is that relative strength is resting on the lower boundary of that trading range. I doubt whether it can hold there. So I had to move it to an underperform because it's inside lagging. We're moving down. We're testing this resistance. We're not being able to push higher while other sectors are. So if we actually bounce off here and we go back up, I'm the first one to move it back to outperform. But for the time being, I'd like to keep it at an underperform together with utilities. And the two positive sectors, XLV is on the right. It's moving lower, but it's still on the right, which means that it's got a strong relative trend, and I'm going to keep an eye on this. It was disappointing that I wasn't able to break out of this range, but the relative strength ratio, RS ratio, is still at a relatively high level. We should not drop much further down, so I'm looking for this support level here, these old highs from October 2018 to hold up and potentially catch that decline and make it move higher. And then finally we have the discretionary sector, which pushed against an all-time high on both relative strength and price. This is a strong move. Look at that RRG lines. They're moving higher. They're doing really, really well. So I'm going to keep it at that for the time being. I will need to write up the new long and short ideas in a blog article. I will include some of the stocks that I mentioned in your Daily 5, which I did last week on the 11th, and in the pitch, which I participated in together with Greg Schnell and Mary Ellen McGonigal on the 12th. If you have not seen these shows yet, please go check them out. This was Sector Spotlight. Thank you for watching. I hope you enjoyed the show. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, with replays on the StockCharts YouTube channel. As usual, stay safe, and I hope to see you again next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, Give us a like down below, leave us a comment, we'd love to hear from you, and most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.